Hi, this is Fred Barstein, editor-in-chief at 401k-TV, and I'm here today with Matt Soifer, managing director at BlackRock, who's the head of institutional distribution. And we're here to talk about how employers sponsoring a retirement plan can help manage participant behavior for their own benefit through target date funds. So welcome, Matt.
Thank you, Fred.
Morningstar reports that investors in funds can have a lower rate of return of the fund. How does that happen?
Yeah, so I think what you're seeing here are really people's just natural behavioral tendencies at play. I think what's really happening is, if you look at, particularly in down markets, so if you look at things like equity shocks, when the stock market sells down, people get nervous. And what do people do when they get nervous? Well, they start paying more attention and they start to make changes. And so what I think is happening is people are basically cashing out of their investments. They're sitting on the sideline for a little bit. They're waiting to get back in. And in doing so, it's just not optimal. They're much better off if they had just stayed with the fund, kind of think long-term, be that long-term kind of investor. And, to tie that back to target date funds, I think that's what target date funds are designed to do, give appropriate amount of risk at appropriate time, keep people invested for the long haul.
So what are the different behavior triggers for younger investors who might have smaller account balances, as opposed to the older ones who probably have larger account balances?
Yeah, so the younger investors, I think, have one big advantage, and that is time. So they're in a position where they have their entire earnings career in front of them, which gives them a great buffer. So what that means is they have the opportunity to take more risk. They're much younger. They can take that risk. I guess essentially take it when they absolutely can, and maximize, hopefully the compounding effects and other things. And what I really like about getting people saving early is it just becomes a natural behavior that they become used to. It's not anything different for them. They start on the right track from day one. The older investors are just in the challenging spot of, if they haven't saved enough money, how can they, getting on the bandwagon late is just tough. They don't have the compounding effects that a younger person would have. But at the same time, they need to be very cognizant of kind of the risks that are facing them, and need to make sure that they're in a very diversified portfolio that can not only protect against market risk, but at the same time, certainly inflation risk is a big issue for older participants.
So Matt, tell us how target date funds can help engender better behavior and mitigate the downside risk.
Yeah, so I think when target date funds were first established, you saw three main risks that they were really focused on. The first being market risk, the second being inflation risk, and the third being longevity risk. What's nice to see is that target date funds are evolving to also capture behavioral risks. So what they're trying to do is build return profiles such that people stay invested, such that they have good protection on the downside, maximize diversification, and make sure that people are taking an appropriate amount of risk, regardless of kind of where they are in their, kind of retirement journey, whether they're a younger employee or someone who's approaching retirement or someone who's already in retirement.
Right. So they feel more confident that if they're younger, they see, oh, well, I'm not going to retire till 2050, and if they're older, the market might have gone down, but their portfolio might not have gone down as much.
Yeah, that's correct. I mean, we know people internalize losses twice as much as they do gains.
Right.
So that's a very important behavioral aspect to be aware of when you're designing these kind of portfolios.
We're here at BlackRock, which manages over $4 trillion. So we'd love to find out, and you big target date provider, what is BlackRock doing? How do you see this, and what are you doing, to help manage that participant risk through the target dates?
Yeah, so we've been in the target date fund business for about 20 years now. So we've been through all kinds of different market environments in those 20 years, managed about 130 billion or so in target date funds. What we're really focused on is making sure that people post-retirement can consume at levels that they are used to consuming when they were pre-retirement. So if you're used to spending $50,000 a year, we want you to have an experience that's very similar to that. What we don't want to do is take a lot of risk around a person's ability to consume. We think people think in terms of how much they spend per month, how much they can take out of their 401k plan per month to meet those spending requirements. So we're really focused on trying to build those asymmetric portfolios, if you will, the ones that really can participate in the upside, but do a really strong job of protecting on the downside, keeping people invested and giving them a consumption pattern that they're used to pre-retirement.
A lot of what I'm hearing about target date, it's not just based on performance. You have to match, the profile and the behavior of, the workforce, which, the benefits people and the HR people have a, insight into. How can they help in the selection of target date funds?
Yeah, so I think the HR side of the house is really important. They have a huge piece of information that we, the investment manager, don't have, and that is that they know their population best. They know, the distribution of the demographics. They know generally, how risk averse their population is or isn't. They know about if there are other benefits that the company's providing. So, for example, do they provide a defined benefit plan? And these aspects are really important, and they should be, absolutely factored into defining, what is the objective that, that particular employer is looking for. I think kind of absent that full picture, you're probably going to select a target date fund that is suboptimal in one way, shape, or form, and we're looking for something that is going to be effective for the mass population of that employer.
Right. So customized to that employer. So you work a lot with larger plans, and what we're seeing in the research is showing that where it might have started that the plans were picking the target date of the record keeper, and there's some very large ones. That seems to be changing. What do you see happening and why in the larger market?
Yes, I think in the larger market you see this continuing unbundling between record keeping services and the investment management services. At the large end of the market, I think employers want the best vendor they can get in each category. So the best record keeper, the best investment solutions. So look, if it makes sense for them to select the record keeper's product, then they'll certainly do that, but they're going to vet it through just like they would anything else. In fact, I think what we're seeing in the large end of the market is even further unbundling of, not only are you not selecting the target date fund of the record keeper, but you may not be selecting just an off-the-shelf fund, period. They're building a lot more customized solutions that are full open architecture and picking the best managers in each asset class. So that goes even further than kind of a traditional unbundling.
Great. Well, thank you, Matt.
Thank you, Fred.
And thank you for watching 401k TV.